Our guest today is a good friend of mine. We've known each other since elementary school. You've done a lot of really interesting stuff. I've been best friends with your brother since we were knee high to a grasshopper, and I'm really interested to hear some more of your story and a lot more about where you are now and what you're doing now. Travis Kling, how you doing today?
Doing well, Ben. Thanks for having me. Pleasure to be here.
Absolutely. It's a pleasure to have you here. Thanks for being on the show. So let's start at the very beginning. You are a Texas guy and a College Station guy, College Hills all the way through your MS in Finance at Mays Business School. Tell us briefly about your history with this community.
Yep, sure. So born and raised in College Station, third generation A&M. Grandfather grew up in Cossie, Texas. So came back from World War II and enrolled at Texas A&M. Family's been here ever since. Both my parents attended Texas A&M. Older brother didn't really have much of a choice, but didn't really want one anyways. So
okay. So your background is very Texas, very A&M. What are there any ways that you feel like that was a particular advantage in doing the kinds of things that you are doing now? And are there any ways that may have been not as much of an advantage? Are there things that you had to learn? So to illustrate a little bit more for you what I'm talking about, when I went down to Rice, I thought Houston is weird. Like, this place is weird. And I have a lot of love for Rice, but the reason that I felt that way was because I thought College Station was just how communities are. And I've seen over and over again in, adult life that's not really the case. College Station is its own unique place. And I think in many cases that's a good thing. But what were the things that came out of that you learned from being a College Stationite that might have equipped you better for what you started doing in business? Or in some cases, were there any habits that you formed that you had to unlearn?
Yeah. So prior to jumping into crypto asset investing, I had a career in energy investing. Mm-hmm. And the oil and gas industry is, attached at the hip with Texas A&M University. And that's been great. I lived in Texas all my life and up until 2.5 years out of college, and then moved to Chicago and then New York, mm-hmm. and now Los Angeles. So have kind of lived at this point in major metropolitan areas all over the United States. And I can tell you unequivocally, there's no place like Texas.
No question.
And living outside of Texas makes you appreciate the people here even more, and their disposition in general, and the friendliness. I think as I have, moved outside of Texas and moved into a career where, to be frank, I think I would run into less and less Aggies. It made me appreciate being from here even more. And I think that there is, A&M has a reputation for building leaders. I'd like to think that I've been a leader in my career. And as you step outside of the A&M ecosystem and go into the rest of the world, I think those leadership qualities and characteristics that are so, essential and just foundational to getting an education at this place, I think those really have an opportunity to shine.
Let's talk a little bit about leadership. So a lot of people say that playing sports builds character. It builds, the ability to work in a team. You played football into college. What do you feel like sports gave you? Maybe what were some of the unexpected gifts that sports gave you? Something mm-hmm. counterintuitive, perhaps.
Yeah. So football was my life till I was 19 years old. So I played my freshman and sophomore year at Blinn down in Brenham. Was actually going to walk on to A&M, herniated a disc in my lower back my sophomore year in college, couldn't play football anymore. I was a defensive end all growing up. That was a 265-pound Travis as opposed to 200-pound Travis. Ben remembers 265-pound Travis.
I do. I do remember.
But I got an extraordinary amount out of athletics that I found applicable to academics and then to my career. And the number one thing, and I've told this story, I don't even know how many times, because it's so such a big part of who I am. What football taught me was more often than not, the only thing in between point A and point B is just a bunch of hard work. And you have to decide for yourself whether or not you're willing to put the work in to get from point A to point B. But most things in life are not rocket science. And unless you're actually trying to cure cancer, you're not trying to find a cure for cancer. And so a lot of times it's just a function of like, are you willing to push the ball up the hill, or is the ball a little too heavy for you, or you're going to get a little too tired, or you're not quite as dedicated to get from point A to point B. And I think when I was playing football at Blinn, I got there and I was used to being the star of the football team. And then I got there and I was playing football with a bunch of guys that were better at football than I was. And
I know that feeling.
Yeah. And that was a feeling that I was not used to. And I was second string my freshman year, and I had never been second string in anything in my entire life. And I think that got to me and challenged me. And I got bigger and faster and stronger over the course of that off season, and showed up and was one of the, team captains my sophomore year. Had a really good sophomore year that put me in a position that, if I hadn't had an injury, could have gone to continue playing. I think as I moved into, academics, and, it was important to me to, have a high GPA so I could get the job that I wanted to get when I got out of college. It was just like, do you want to study 5 hours and get a B, or do you want to study 15 hours and get an A? And you can just boil more or less all of college down to that. And it's not so dissimilar, moving into a career path as well.
When did you majored in finance?
Undergrad accounting, master's in finance, the PPA program. Shout out to PPA program.
So David Wiggins, my brother, came on the show a couple of days ago, and I asked him a question that I'd never asked him before, which was, when did you become interested in money? When did you become interested in finance? Why that? And he said, well, money, as it turns out, buys you things. And if you have money, you can get a lot of stuff. And I like stuff. So I was interested in money from a very early age. So that was his rationale. It was very honest of him. I appreciated that. So when did you become interested in money, in finance, and what made you want to work in that field?
It's a great question. It's a very A&M centric answer, actually.
Oh.
So I had a bunch of lawyers in my family. Dad's a lawyer, uncles, cousins. Grew up around a lot of lawyers. I actually started working full time. My dad had a small legal practice in Bryan when I was growing up, and I started working full time at my dad's law firm the summer after 6th grade. I was 12, and I would go in with him and leave with him. I think I was working 50 hours a week the summer after 6th grade, which sort of carried that with me the rest of my life, actually. I was, from a really early age, my dad had a lawyer that he was in contact with that was an M&A attorney. And this guy, his name was Bill Fleming. He's passed away. Great guy. He started the M&A practice at Vincent and Elkins. So this guy's a big deal, and had done decades of legendary M&A legal work. And I met him at a really early age through my dad, and in his office, he had cabinets full of tombstones for M&A deals, the little glass trophies that commemorate M&A transactions. And I was 13 years old, and I asked my dad, Dad, what are all those tombstones or what are all those glass trophy things in Mr. Fleming's office? My dad said, those are tombstones. I said, what's that? And he said, it's for an M&A transaction. I said, what's M&A? And he said, mergers and acquisitions. I said, what's that? And he said, it's where one company buys another company. And I was like, one company buys another company. And I remember clearly, I was 13 years old. And the only frame of reference for buying things that I had was like, I go to the mall and I buy a CD, or I go and buy a pack of baseball cards. And then it was like one company buys another company. And I didn't really understand exactly what that meant, but that sounded like the coolest thing I'd ever heard of. And so that's what I wanted to do. So if you'd ask 14-year-old Travis, what are you going to do for a living? I'd say M&A attorney. I was 14 years old, which is a really funny thing. So from the time I was 14 until the time I was 20, that's what I wanted to do. And I was in the pre-law society here, and I was like going to go crush my LSAT and go get an Ivy League JD. And I was going to do the PPA program here. So I'd get my CPA, and then I'd go get my JD, and then I'd be super set up to do M&A law. And that was the plan. Mm-hmm. And it tied into, as I got, into high school and into college, it tied into how I felt my strengths were, which was I always considered myself verbally much more sort of that type of brain than quantitatively. And really the sense of that was like in high school, it was really easy to make an A in AP English. And I had to study hard to make an A in AP calculus. And that was just sort of the way it was for me, and always great at giving speeches, all that kind of stuff.
Sure.
So I got all the way to Sally Guyton's Finance 341, which was like the class to kind of make, like, not really the weed out class, but sort of the weed out class for the PPA program. And people that thought maybe they wanted to do the PPA program would get into that class, and they'd have a hard time with that class, and they decided they needed to do something else.
Okay.
And I took that class, and people were having a really hard time with it. And one, it was super interesting to me. Like, really found the content just deeply fascinating, and it was a duck to water. And I can't remember. I think I made like a 95 in the class, crushed it, and it was super easy to me. And I was like, Travis, you should probably pay attention to that, because you kind of thought you weren't a big numbers guy, and now all of a sudden you are. And then about that time, I got a good understanding of what investment banking was. And investment banking is sort of the numbers side of an M&A deal, where M&A attorneys are handling the legal side. Mm-hmm. And so that was, at that point, I kind of turned my direction from a career path towards investment banking.
Okay. And so then, piggybacking off of that, you started out in energy, as you said earlier, yep. Simmons, then Magnetar. So tell us a little bit about that process. Like, what, and what we always go for is what subverted your expectations? What was, like, people can ask, what did you learn from that? And you can just you can offer conventional wisdom, stuff that sort of makes sense to everybody. But what were the things you learned that surprised you during your time at Simmons and Magnetar?
At Simmons and Company, I learned financial analysis. I worked with a great group of guys there, deeply appreciative of my bosses that I had there and the mentors that I had there. And I got a school in July, or I got a school in May of 2008, went to work at Simmons and Company first week of July of 2008, which was the all-time high in WTI prices. WTI was like $142 a barrel.
Yeah.
And then I took the financial crisis in the face, the first 6 months.
Yeah.
I was out of school, and that was crazy. I'll never forget, everybody has their kind of where were you moment when Lehman collapsed. And I'll never forget that when I was in Edmonton, Canada, inside of a oil and gas valve manufacturer. And we were trying to wrap up confirmatory due diligence on a $300 million sell side transaction. And I was sitting there, on Google Finance watching the world fall apart. It's pretty crazy. But I think I learned a lot there from the guys that I worked for about how to run a good team, how to, you work a lot of hours in investment banking, but I think almost all of, almost all my friends that worked at other investment banks, especially in New York, had more painful investment banking experiences than I did. And, which is to say they worked for a lot of guys that weren't like such good guys, or worked in environments that were, not the best environments, to help, get a knowledge base, to go build your career on top of. And that was really what I think my time at Simmons was about, was you're out of college. You don't know much of anything. Hate to break it to the college students that are listening to this right now, but as much as you think you don't know anything. And so what my time at Simmons allowed me to do was just be on a really steep learning curve. And the learning curve steep, and your opportunity to move up it is it's unencumbered, because you can work twice as much as you would in a normal job. So not only is it steep, but you can move up it fast. And so I was there for 2.5 years. It's probably like five years worth of experience in a lot of other jobs. So then I went to Magnetar, and I was at Magnetar Capital in Chicago from 2011 through the middle of 15. So that was the go-go years in oil and gas. And when I joined the energy business there, which operated like its own autonomous hedge fund within the broader Magnetar. Magnetar was 11 billion AUM when I joined. The energy business was managing 250 million when I joined. I was there for 4.5 years. When I left, we were managing 4.6 billion. So I had massive AUM growth over that period of time. We were doing long, short energy equities and non-controlled private equity and debt in the energy space. So up and down the capital structure, broad investment mandate, long investment horizon. In the liquid book, we'd invest in stocks that traded $1 billion a day. And in the structured business, we would write a $75 million check into a financial instrument that you couldn't get out of for 3 years. So it had this cross capital structure investing experience, and had an experience investing in extremely liquid instruments and extremely illiquid instruments, which didn't know it at the time, served me extremely well moving into crypto. Because I think I've got a pretty good amount of experience thinking through how much is it worth if I can change my mind tomorrow. So we had a lot of success when I was at Magnetar. Worked on a great team there. 7 investment professionals when I started, 9 when I left. We won 2012 Specialist Hedge Fund of the Year from Hedge Fund Research Magazine, and raised hundreds of millions of dollars from the most institutional investors on the planet, big state plans, pension funds, endowments, the BlackRocks of the world. Investment banking teaches you a lot about financial analysis, doesn't teach you a lot about investing. Learned kind of everything that I think I learned my entire foundation of investing more or less when I was at Magnetar. And again, worked for a great group of guys, really smart group of guys. Specifically because we were doing this cross capital structure investing, we had the opportunities. So we played a lot in the middle part of the capital structure. So we did a lot of, not to go too far down the rabbit hole here, but we did a lot of private convertible preferred equity. So we would write $150 million check into preferred equity that would then convert into the common publicly traded equity of an energy infrastructure company. We did a lot in midstream energy companies. Mm-hmm. And so we would write these instruments, and we would put together a base case that looked like it was kind of low to mid-teens returns.
Mm-hmm.
And if something really bad happened, it was probably high single-digit returns. And if if you hit your upside case, then maybe you were high teens, or up to maybe up to low 20s. And you would look at the risk profile of an investment like that relative to, and it'd be like a 3-year, you'd be locked in for 3 years, maybe as long as 4 or 5.
Okay.
And you go look at that risk profile relative to trying to go do that in the public market space,
mm-hmm.
and go and try and hit 14% returns 3 years in a row in the public markets, and the amount of risk that you'd have to go take to try and go do that in the public markets relative to what you were getting in this,
it'd be crazy.
It was extremely attractive, right? And so it gave me this this really good knowledge base of risk-adjusted returns in the context of cross-capital structure investing and in highly liquid versus illiquid instruments.
Mm-hmm.
Yeah.
So a couple of things will come back. You mentioned institutional investors, which we'll definitely come back to later in the context of our crypto conversation. You also were talking a little bit about just the grind at an iBank or a hedge fund. And so sometimes it can be tough to contextualize the grind. Like I worked in football with Coach Fran a dozen years ago and worked in the entertainment business, and the grinds in those industries are different. I wouldn't say one is necessarily easier than the other, but they're very, very different. So, and I heard one of Kevin Sumlin's GAs last year complaining about their 60-hour work weeks, and I wanted to pat him on the head.
Mm-hmm.
Bro, 60 hours. That sounds like a sweet dream in the college football world. But so putting numbers on it, what is iBanking like? What is a hedge fund like your first several years out of school? Like for people who might be interested in going into an industry like that, what's your high end? What's your low end? How often do you hit each one in terms of just the raw work hours? And obviously some of that is choice.
Yeah. It's probably, so I tell people 15 times 7 is 105.
Mm-hmm.
So if you work 15 hours a day, it's 7 days a week, that's a 105-hour work week.
Mm-hmm. Definitely
had 105-hour work weeks before. It was a little less in hedge fund investing when I was at Magnetar. When I was a portfolio manager at Point72, it was a little more just because it was my baby,
mm-hmm.
And I was had complete discretion over my portfolio. But 50 hours on the low end, and I think I have found a pace throughout my career of 65s, I think, feel pretty sustainable for
mm-hmm.
me. I wish I was smart enough to get the work done with a bunch less hours. But I hadn't figured out how to do that yet at any point in my career. And, I think, there is, people talk about work smart versus work hard. I think I've always tried to take the approach of doing both. And if you want to get far, or you want to achieve something that is fundamentally difficult to achieve in this life, I don't know what world you live in where you think that that's going to come easy,
mm-hmm.
but that's just not the way the world works. And so the quicker that you come to that realization in life, the better off you're going to be.
So you mentioned Point72. I always wondered where that name came from. Is it the Rule of 72?
People talk about that. The address of the headquarters in Stamford, Connecticut is 72 Cummings Point Road.
Oh,
so
there you go.
But it's probably a nod to the Rule of 72 a little bit as well too.
Sure.
Probably both.
You mentioned you were on Pomp's show, Anthony Pompliano,
yep.
I believe. You were on his show, and he was under the impression, or sort of made the assumption, that at a place like that, the guy next to you, the guy down the hall, is coming for your spot. And you said at 0.72 that was not necessarily the case. Like, there was obviously, everybody's good at what they do, but there was a sense, I don't remember exactly how you put it, but there was a sense of team, in the sense that it's not a zero-sum game. My success is not your failure. Can you talk a little bit more about that? Yeah,
sure. Great place to work. I think it just felt like pro ball. That's just what and not that Magnetar didn't feel like pro ball, but I don't know. Maybe if Magnetar was pro ball, 0.72 felt like the Pro Bowl.
Yeah.
And it was undoubtedly a meritocracy. So maybe sometimes people confuse a meritocracy with a cutthroat or a I'm trying to make this guy do worse. Or I'm trying to, do whatever I can to beat the guy next to me, but it's two different things.
Right.
In the meritocracy in the context of, a place like 0.72 is, if your ideas make money, they're going to give you more money. If your ideas lose money, if they lose money long enough, they're going to ask you to leave. And that's a pretty straightforward situation. As a guy that came from athletics, one of my most favorite things about hedge fund investing as an industry is how black and white it is. And you got a scoreboard, and it doesn't matter if, you can be fat or skinny or brown or purple, or, people can like you or hate you, and you can be a Christian or a Muslim, or it doesn't matter. Do your ideas make money, or do they not? And I just always appreciated I didn't have to go try and play office politics. I just had to try and be thoughtful about investing ideas. And that just felt like a nice sort of straightforward landscape to come to work and try and succeed in. And the firm itself had the most tremendous platform of resources you could possibly imagine. Like, just a stunning amount of resources. Anything that you possibly want from an information perspective, you got it. You want to talk to any C-level executive of any publicly traded company on the planet, we can get that done, within the next couple of days. Just anything like that. And so it was great, and learned a ton. Steve Cohen, the guy that runs it, one of the most famous hedge fund investors of all time. And, it's not like he was sitting down once a week and giving seminars about how to invest, but, you spend enough time around the guy, and, you can certainly pick up some great things. So
in the process of that, you had sort of kept an eye on cryptocurrency. You read about the collapse of the Silk Road, the hack of Mt. Gox, I think it was called.
Yep.
And in that process, you fell down the crypto rabbit hole. So quoting yourself in Fortune magazine, tell me about magic internet money.
Yeah. So as we talked about so far, like, I'm not a tech guy. Don't have a tech background, not a tech investor, not really a tech kind of guy either. Don't own an Apple Watch, Alexa's big brother. Just always felt like that. So it took me a while, and I am also cautious. I'm a cautious investor, and I'm like cautious as a person, like would never go skydiving. And I invest like, I put like one little foot out like this and kind of like test the waters like that. And,
which is interesting, because hedge fund investing sort of has this rep as sort of a bunch of gunslingers.
Yeah.
What do you think? So do you think that most iBankers, most hedge fund guys, like, would most people be surprised at their sort of conservative personal risk profiles, or are you an exception to that?
You'll see all different types. You will definitely see all different types. I think I just, in the context of sort of the hedge fund investing spectrum, I think I just happen to be on the cautious side of things. So it takes all different types. And that the gunslinger, look, I think people that haven't worked at a hedge fund before, haven't managed money before, think that it's like an episode of Billions.
Oh yeah.
Or they think it's like Wolf of Wall Street, or they think it's like Boiler Room. And it's way less sexy than that. What it's really about is you build an investment framework, and then you put a bunch of processes inside of that framework, and then you build a bunch of tools that help you execute those processes. And in the same way that Henry Ford used to crank out Model Ts, you can crank out attractive risk-adjusted returns on a repeatable basis like that. And Point 72 is like kind of like the Navy SEALs of that type of investing strategy. And it is it's like the like Wall Street, I'm going to go party all night and then show up at the office and make a bunch of money and like something like that. It is nothing like that. It is way too cerebral of a job the guys walking around, we're a bunch of nerds, man. It's just a bunch of nerds looking at a bunch of computer screens all day. And it is, I think it is a job. I tell people, hedge fund investing in publicly traded instruments, if you have a really analytical brain, then it's like heaven for you, right? And I've been like that my entire life, highly analytical my entire life. So felt like I kind of had a brain that was built for it. And so pulling that back to crypto, I basically, read a little bit about it in late 13, a little bit more about it in early 14, stopped looking at it at all for 18 months, popped back up on my radar in late 2016, right around 2 years ago, when BTC's price started going back up again. And I remember being amazed at the Mt. Gox got hacked in early 2014. 70% of Bitcoin volume traded on Mt. Gox. They stole a couple 100,000 BTC in total, which is just like imagine you wake up tomorrow morning and somebody stole half the stocks off the New York Stock Exchange. And you can't get them back. Nobody knows where they went. And you can't get them back. And then imagine 2 years later, the New York Stock Exchange not only survived that, but was meaningfully stronger than before it happened, less than 2 years after that. So that's what I saw in late 2016 when I stepped back into the Bitcoin ecosystem. I saw an ecosystem that had taken this gargantuan left hook in the form of Mt. Gox and was not only standing but thriving, and that was super interesting to me. And then you roll to early 17, Ethereum and all the ICOs started going crazy, started reading more about it. And then I basically came back from July 4th break last year and fell down the proverbial crypto rabbit hole and just started spending all my time reading about crypto.
So let's talk briefly about that. I think the reason that crypto did, as you said, not only survived an enormous setback like that, but is thriving and growing explosively despite all of that, is because the idea of cryptocurrency, the concept of it, is very philosophically attractive. And there are aspects of, so if you would, for our audience, let's talk about it at the most basic levels. What is cryptocurrency and why do people want it?
Yep. So we use the term crypto asset instead of cryptocurrency.
Okay.
And instead of blockchain, we use distributed ledger technology, DLT for short.
Okay.
So when you hear me talk about this technology in this asset class, you'll hear me talk about DLT and crypto assets.
Okay.
Distributed ledger technology is blockchain is a type of distributed ledger technology. There are other types of distributed ledger technologies. Blockchain is far and away the most popular one. It remains to be seen whether or not it will be the eventual winner, which is why we use the larger umbrella term DLT.
Does this tie in with the proof of work, proof of stake stuff?
It does.
Okay.
It does. So distributed ledger technology is an information protocol.
Okay.
in the same way that HTTP is an information protocol and SMTP is an information protocol.
All right.
You built the World Wide Web on top of HTTP. You built email on top of SMTP.
Yes.
The guy that invented HTTP isn't a billionaire. The guy that invented voice over IP is actually a friend of mine. He has a lot of money, but he didn't get it from creating voice over IP because value didn't accrue at the information protocol layer. It didn't accrue at HTTP. Instead, what it did was it was a platform, and you had companies that were built on top of HTTP, and they charged revenues for the products and services they provided on the platforms that were built on top of HTTP. And the equity of those companies accrued value. And that's the internet as we know it today.
This is a fat protocol thesis?
Not quite.
Okay.
And so now with the introduction of a crypto asset that is associated with that specific DLT, it allows for value to accrue in that token rather than to leak on top to the application layer. And that's really, really revolutionary. And the very simplistic example that I give to people is imagine the guy that invented HTTP. Imagine if the day he invented it, he created 100 million HTTP tokens. And each token was 1/1000th of 1 cent.
Okay.
And if I wanted to log on to the World Wide Web, I had to pay 1 HTTP token. But there weren't going to be any more HTTP tokens ever made. And then you built the entire internet, and the internet was today. Like, what do you think the value of an HTTP token would be?
Yeah,
right.
I don't know, but
directionally, you get my point, right? So that is what we see today with this technology and this asset. Crypto assets are a new asset class that is built on top of a new type of technology, DLT.
Okay, so if those things, if you're translating that one-to-one, the idea is that the real value is in DLT. Is because and tell me if I'm not understanding that correctly, because in HTTP, like, the tokens are just a representation of what the utility that I can generate from this building block on which the internet is constructed. So the only reason I'm saying this is because I want to correctly understand what it is that people find valuable at the most basic level about DLT or the units of currency in which DLT is represented.
So there are many use cases for distributed ledger technology. Currency is one of them.
Right.
It is the one that is most easily understood relative to what else we see in this world currently. Bitcoin is vying to be digital gold. A non-sovereign store of value, in the sense that there is no government that controls the supply and the demand of it. And if you ask a gold bug, is your dad a gold bug? No. If you ask a gold bug would tell you that these days gold doesn't really work like it should. Because so much gold is held by central banks that the price is kind of manipulated relative to what's going on with sovereign issued currencies, fiat currencies across the world. And so what you now have is the Bitcoin blockchain, and the value proposition that BTC makes relative to its status quo, which is gold. The framework you put around that value proposition is like an Austrian economics type of framework. It's a hard money versus soft. It's a sound versus unsound money. The 6 characteristics of money. I'm sure that gets taught here at Mays Business School.
Yeah, you're talking about things like fungibility, divisibility, transfer friction,
limited supply.
Right.
Yeah.
Okay.
And so in the current market environment, when you put BTC next to gold in the context of that type of framework, it actually looks pretty good.
Yes.
And that has folks very interested, especially in the context of what we've seen from the global coordinated central bank monetary policies on the back of the global financial crisis. We are in the midst of the largest monetary experiment in human history. We've printed, I can't remember, it's like $17 trillion since the financial crisis across the 5 largest central banks. Mm-hmm. And it has distorted asset prices in some really tangible and concerning ways. I think there's something like $15 trillion of negative yielding sovereign debt. So just fundamentally, how does something like that happen? Well, it happens when you push so much liquidity into the world that it distorts the fundamental nature of asset prices. And, money as a use case for distributed ledger technology is a way to opt out of that, or take a very small percentage of your portfolio, 1% of your portfolio, 5% of your portfolio, and say, this is an uncorrelated asset. This thing operates in a totally different framework than any other asset class: real estate, private equity, currencies, fixed income, developed market equities, emerging equities. This is something very different. Right. And, the weighted average probability that this, something like BTC is successful relative to the returns that would be generated if it is just marginally successful, makes it something that you have to look at from an investment perspective.
That makes sense. So now we have a bunch of different crypto assets out there. You have BTC, you have Ethereum, and there's a bunch more that I don't even remember the names of. So it seems like at least some of the differences that between those crypto assets are in the way in which they handle either the blockchain or more generally the distributed ledger technology. Like, are there any of those that are the same in every way except they have different names? Or are they all actually, is the underlying structure of all of those crypto assets actually different in subtle or not so subtle ways?
It's a good question. There are many use cases for DLT.
Right.
A currency or a store of value is one use case. Ethereum is a completely different value proposition from BTC. Ethereum is simplistically trying to be decentralized computational processing power to run what are called smart contracts. Okay. Which is just coded logic, computer program coded logic to execute a series of commands. Okay. And ETH, the currency, is the utility token that powers this sort of decentralized computational processing ecosystem. Mm-hmm. You can build prediction markets with distributed ledger technology. You can build decentralized storage. You can do all kinds of things with supply chain logistics. You can do things with record keeping. You can do things with micro payments in an IoT economy. There's many use cases. All those ones that I named, it's early for all of them. Mm-hmm. It is 1992, and we're just starting to put newspapers on the internet, and people used to value the total addressable market of the internet as the aggregate value of all the newspapers in the world.
Right.
And so it is a little difficult at the point we are right now. Take money or store value, put it off to the side, because that value proposition is pretty clearly understood right now. Right. Or at least it's understood plenty well enough that you can speculate on the likelihood that it might happen. All those other ones, there's a lot more work to be done. Mm-hmm. However, the amount of human capital that is running to this asset class to go solve these problems is breathtaking. And, I'd like to think that in my prior career path, I've worked with a bunch of really smart people. And there are just as many, if not more, smart people that are working on solving all those new use cases for this technology.
Well, and in your words, when the internet came along, we didn't have the internet to help us understand the internet.
Yeah.
And now we have the internet to help us understand DLT.
Yeah. So that speaks to the pace of evolution in this asset class, which again is completely unlike anything that I've ever seen before. The space evolves in a Darwinian manner and in a Cambrian explosion manner, and that's because the vast majority of this technology is open source. And so every new project that comes along, at least in theory, has, and in many cases in actuality, has the knowledge of all the prior projects that came before it. So the saying, standing on the shoulders of giants, each new evolution of projects in this space gets to stand on all the shoulders of all the other projects and evolve it just a little bit forward. So you understand what I mean when like Darwinian and Cambrian explosion, right?
Oh, yeah. Sure.
Yeah.
Yes. But talking about the open sourceness of all of this, so I've seen some of your stuff on Twitter. Obviously, I've listened to some of your previous interviews. You talk about the open sourceness of this, the idea of Wikipedia versus Britannica, disruption of the status quo, fake news and shilling. So talk a little bit about the information markets around what I'll just call distributed ledger technology in general, like just broadening it out even beyond crypto assets. So what is that world like? What are the goods and bads? It sounds like there are a lot of both.
Yeah. So it's that's right. It's like the best and the worst. Like crypto Twitter is its own little corner of Twitter, and it's like the best and the worst simultaneously. So you have ridiculousness and fraud and charlatans and liars and everything like that on crypto Twitter. And then you also have savant level intelligent people that are tweeting on a regular basis about what they're building, what they like, what they don't like, the manner in which they think this ecosystem needs to evolve. Mm-hmm. And they're giving that to the world, and they're inviting feedback. Right. And they're going to conferences and giving presentations, and that presentation is on YouTube. And they're going on the crypto podcast like that. That's like a whole ecosystem as well too. And the smartest guys in crypto are going on podcasts and going in depth about what it is that they are seeing in the space right now. Mm-hmm. And so that's what I mean by that, like Wikipedia approach versus the Britannica approach, because, in my prior career path, my information sources were like sell side equity research, right? So I'm at Point 72. Point 72 is a big client of Goldman Sachs and Morgan Stanley and Bank of America and, every other investment bank on the planet. And so these guys would provide us all of their research, and they'd have the buy reports and the sell reports and the in-depth macro pieces and this, that, and the other. And because we were a good client, then I got access to all that research. But like, you couldn't get access to that research, right? Like any regular, if you try to buy it, I don't even know how much they'd charge you, $200,000 a year for it or something.
Prohibitive.
Crazy. Yeah.
Is the short answer.
Yeah, of course. And here, the most in-depth pieces are being written on medium.com for free. Mm-hmm. Available for free. There's barely a tangible paid research ecosystem in crypto, because all the smart guys are talking out in the open. It's one of this ecosystem's greatest strengths. Right.
And then on the other side of it, also one of its greatest weaknesses, maybe not weaknesses, but you have to go in with your shield in front of you. And you used a word several times that I'll paraphrase as tomfoolery. And you accused some of the bigger names in the business. I won't name any names. I'll let you choose who and what you want to say. Yeah. But what are if you can zoom this out to as non-technical a place as you can. What are the bad behaviors that we're seeing? I mean, shilling is an obvious one, conflicts of interest, but what are the other bad behaviors that we're seeing in this space?
So the U.S. regulatory bodies, SEC, CFTC, FinCEN, are cleaning up the space in very real time. You've seen a number of enforcement actions this year. You're going to see a whole bunch more next year. The long arm of U.S. regulators can stretch internationally in some cases. It remains to be seen because there are some major exchanges and crypto ecosystem participants that are based in places like Malta, where you can kind of do whatever you want to. And that has led to some actions that are not in the best interest of the long-term health of this ecosystem.
Sure.
And it's kind of like Lord of the Flies, to be honest with you. It's kind of like you see, you know what it is? It's a lot of low time preference activities. It's ecosystem participants that are willing to do something that is detrimental to the long-term health of the ecosystem. And the analogy I use all the time is like those vines that wrap around the trees that are going to kill the tree if you don't cut the vine off. There's that type of activity that goes on right now. And you have ecosystem participants that are willing to go be that vine if they think they can make a couple $1 million, or in some cases a whole bunch of $1 million in the near term. And it'll be somebody else's problem if it ends up being, poisonous to the space. And in the absence of, and again, I certainly, as you can probably imagine, lean a little bit on the libertarian side of things. Not in the spectrum of crypto, I'm not even close to the most libertarian, but I have a tendency to, smaller government's probably a good thing. But in cases like this, when you don't have any kind of regulatory body that was overseeing what was going on in this ecosystem in 2017, you just had things crop up that were just, not what you want to see at all. And
right. Well, even us small government types, and I am one also, but I mean, we need roads, we need police, and police, law enforcement is something you don't want privatized.
Right.
And when it's very easy for us to look at, the modern United States infrastructure outside of crypto, just look at the world and say, we need smaller government. But that takes some things for granted that you can take for granted in American politics, but you probably can't take for granted in a space like this.
Yep.
So then rolling off of that, you have said that you think the things keeping really big institutional investors out of the crypto market so far are fourfold: regulatory, which is what we're talking about here, custody, prime services, and valuation. Can you talk a little bit more about those concepts at a basic level?
Yep. So custody for crypto assets, I think people are probably familiar with this. If you have your Bitcoin sitting on an exchange, that exchange can get hacked. And it's like the world's biggest bug bounty for hackers. Because if you steal cryptocurrency from a exchange, your ability to go and monetize that and not get caught, it's a lot higher than going and stealing like $5 million out of a bank and then figuring out what to do with that.
Yeah.
And so if you have your crypto sitting on an exchange, it is susceptible to being hacked. Although, don't get me wrong, places like Coinbase I'm intimately familiar with their custody solutions, and they are astonishingly strong. So I will say that. And so then if you don't want to keep it on exchange, then you keep it in a cold wallet, which is basically like a flash drive. And the flash drive has a password on it. And so you enter the password and it basically unlocks this thing, and you can, take crypto off of it and do whatever you want to with it. If you lose your password, to that flash drive, then you can't get your crypto back. There is if you lose the flash drive itself, then when you first get the flash drive spits out at you 24 random words. And you write down those 24 random words. And if you lose the flash drive, then you can buy a new flash drive and you can enter those 24 new words and it'll bring that one back up. But if you lose your flash drive and you lose your 24 words, then your crypto is gone forever. And it doesn't matter if it was $10 worth of BTC or $10 billion worth of BTC, you ain't getting it back. That's terrifying, right? So like you want institutional investors to come into the space, but like, oh, you want like whatever, like, you know, Fidelity or like BlackRock's going to come buy a bunch of crypto. Like, what are they going to do? They buy $100 billion worth of Bitcoin and put it on a flash drive and keep it in a filing cabinet? Like, how are they going to do it? So custody is an issue. Regulatory uncertainty is undoubtedly an issue. That's getting cleaned up in real time.
What are the biggest steps that they're taking to clean it up? Like, you know, what are the three most important things that they've done?
So the number, I'll boil it down to one. It's called the Howey test.
Okay.
Do you guys talk about the Howey test at Mays Business School? So this is determining whether or not a financial instrument is a security. You define the Howey test is an investment of money into a common enterprise with the expectations of returns on the sole efforts of others. So those are the 4 prongs.
Can you spell it?
Howey, Howey. And it's based on a piece of judicial legal precedent from 1949 about orange grove trees in Florida. So we are using a law about orange grove trees in Florida to govern magic internet money. That's a little unfortunate, but that's the world we're living in.
Sure.
So,
well, it seems just from hearing you describe the test, it seems like a pretty robust way of thinking about it.
It's okay. And so right now, basically what they're looking at is all these ICOs, many of these ICOs that were issued in late 16, 17, early 18, passed the Howey test and were indeed securities, and essentially none of them registered as securities. So that was the sale of unregistered securities to investors, which is that would be a no-no.
Yeah.
So all that's getting backed out right now. There's other things, trying to decide whether or not some of this stuff is Bitcoin's been deemed a commodity, Ethereum has been deemed a commodity.
Okay.
The SEC and CFTC are working together to figure out. They've actually introduced the concept of crypto assets that could start out as a security and then morph into a commodity. So now you start, okay, that's definitely a new asset class,
yes,
right?
Yeah.
They've introduced this concept of sufficient decentralization because it's on the sole efforts, the sole managerial efforts of others. And the view is that like if this thing is if a network is a thing because 10,000 people are using it, then it's not a security. It's like this collective community, and it's the size, it's the decentral, the magnitude of decentralization that makes this thing valuable. And so maybe it's not a security. So they're working through some of these concepts right now. The U.S. regulatory body has actually been less heavy-handed than feared. They've been pretty good. And so I think they want to see this thing flourish. They, want to make sure that there's not a bunch of shady stuff going on. And so those lines, number of those lines have been drawn in the sand year to date, and they'll continue to get drawn in the sand over the course of 2019 as well too. Okay.
And then briefly on prime services and valuation.
Yeah. Prime services is just like a prime broker. If you're a hedge fund, then whatever, Goldman's our prime broker, Morgan Stanley's our prime broker. And that is just basically providing collateralized lines of credit so that you facilitate the buying and selling of stocks as opposed to having to sort of fully collateralize every buy or sell, and then stock lending and margin trading are kind of the big buckets. It looks a little bit different in crypto, but essentially this is like the liquidity, to sum it up in a sentence, this is infrastructure that facilitates liquidity for institutional investors to invest into the asset class. And that it's a backbone. And this is a backbone that, I think Main Street doesn't even really realize exists in traditional Wall Street investing, but it's like, a multi-trillion-dollar business. And then valuation. So the way I tell people is, so in my old line of work, if I'm going to buy a share of ExxonMobil today, am I paying a lot or little for a share of ExxonMobil? Well, the price of an ExxonMobil share doesn't tell me whether or not I'm paying a lot or a little. It just tells you the price you're paying.
Right.
So if I'm going to try and figure out whether or not I'm going to pay a lot or a little for a share of ExxonMobil today, I got about 30 different tools in the tool shed. A lot of those I learned for the first time at Mays Business School. A lot of them are relative valuation metrics, right? You've got relative valuation metrics based on revenues and assets and earnings and cash flows. I've got, I can take my oil price assumption, plug it into my ExxonMobil model. It'll spit out an EPS. I can slap a PE ratio on that EPS. That'll give me a stock price. I can think of what a share of ExxonMobil represents in the context of like the global macro framework. Are we risk on? Are we risk off? I can take a view on what OPEC's going to do. I can invest in look at ExxonMobil in the context of that. I can look at something like a multi-factor model, a Barra Beta multi-factor model, and looking at it through that lens. So essentially all that goes out the window when you step into crypto. So folks are, because this is not equity. This is not a legal claim on revenues, assets, earnings, or cash flows. What it may be, what we think it is an intrinsic claim on network effect. And you have the value that's created by the technology, and you have the value that's accrued by the token. And the bridge between those two things is token structure, token economics. Maybe you've heard that word before, that term before. Token economics is simplistically the manner in which the supply and demand of a token intersects with the use case of the technology of the underlying DLT. Yeah. And so this is a real new area of valuation. It's fascinating. I can tell you right now, if you're like a valuation guy, it is so fascinating. And I've said this now for close to a year, if they gave Black-Scholes a Nobel Prize for figuring out how to price options, whoever figures out how to price crypto assets in the same type of way, there's totally a Nobel Prize waiting for that. And so it's fascinating to be on the bleeding edge of that.
Yeah. Well, I mean, Gene Fama won a Nobel Prize, 25 years later. But, and Schiller and those guys, I mean, like I'm more of a CAPM, Fama and French. Like that's kind of that's where I feel safest in terms of valuation. But this just opens up like a whole, it makes the whole thing multidimensional.
Yeah.
Like you have to be able to like in a way, visualizing it is a tricky beast because you can only think about certain pieces of it at a time.
Yep.
So then rolling out of that, you have founded and serve as chief investment officer for a company called Ikigai Asset Management. That's a favorite word of a previous guest of ours, Dr. Janet Marcantonio.
Oh, nice.
So tell us what you guys do.
Yep. So Ikigai Asset Management is a crypto asset hedge fund. We seek to generate superior risk-adjusted returns on a repeatable basis. We do that through investing in venture stage crypto asset projects, both newly issued tokens and the equity of the entities that are issuing the new tokens, and both long and short liquid crypto assets. Very simplistically, the way to summarize it is in the same ways that traditional hedge funds have been deploying strategies into traditional asset classes for decades, you can kind of take those types of strategies, rejigger them a little bit, and deploy them into this new asset class. And so that's a lot of what we've done.
What do you bring to the table that no one else does? How are you differentiating yourselves?
Yeah. So I've got top couple percentile institutional investing experience. relative to anybody else that's trying to do this in the crypto asset space. There's not another portfolio manager from Point72 that's running a crypto fund. There's a term called quantamental. It got thrown around a lot at Point72.
Yeah, I've heard you use that one on your other shows.
Yeah, the intersection of fundamental and quantitative investing, or said differently, harnessing the power of big data to help humans make investment decisions.
Right.
So quantamental investing is at the core of how we deploy capital into liquid crypto assets for our liquid crypto asset strategy. And so simplistically, the way that looks is I've got analysts on my team doing deep fundamental qualitative research around what is going to make these instruments accrue value and how that's going to look, and attractive pockets of investment and unattractive pockets of investment. And then I've got quantitative analysts that are doing what is called alpha signal research. And these are guys that came from traditional quantitative hedge fund backgrounds. And that's about doing all kinds of things with all kinds of different types of data to try and draw investable conclusions from that data. And so what we do at Ikigai is you create a two-way street. You have fundamental guys that are establishing qualitatively based theses, and then you use quantitative data to track and analyze and assess the validity of those qualitative theses. So that's the road going one way. At the same time, you've got quantitative guys that are looking at all sorts of different data and doing all kinds of different things with it. And they are finding interesting things that happen in the data, and then presenting that to the qualitative side and seeing if you can wrap a qualitative story around what's showing up in the quantitative data. So that's kind of what quantamental looks like. We have discretionary strategies where I make investment decisions, and we have quantitative strategies where an algorithm makes investment decisions. And so we do both of those things simultaneously and deploy capital in a dynamic way across a number of different strategies.
It's really fascinating to me the way that the weave of data and narrative have sort of like they're kind of spiraling together at this point. And the idea that we're almost to the point where we can start quantifying story. We're not there yet. And I think to a degree, you don't want to stifle creativity, but the idea of there is now an algorithm, Spotify, Pandora, like there is an algorithm that can tell you what kind of music you're going to like, and it gets more specific every single day.
Yeah.
And so I don't know. I find that stuff pretty fascinating. I play in a very narrow investment space. And so for us, like the fundamentals are the data, like we're working with, we take a pretty quantitative approach, but that's neither here nor there. So how do you feel like your Mays education prepared you for working in this strange and wonderful corner of the professional world? What were the best things that you got here?
Mays was a great foundation. Accounting is the language of business. I wasn't planning on being an accountant when I got out of college, but I tell people it was like learning Spanish to run a Mexican food restaurant. And it's been the language that I've used for financial analysis throughout my entire career. I think I was presented with just enough. In grad school, we covered just enough about behavioral economics that it got me really, really interested. And I actually did, in aggregate, I'd say a couple hundred hours of self-study while I was in grad school, but specifically on behavioral economics, because it struck me as the most accurate way to describe the way that behavioral economics is the study of human decision making in the context of investment decisions. or economic decisions.
You're talking about things like prospect theory and
all kinds of different things like that, and game theory, mechanism design, more broadly,
rationality traps.
There you go, and I think efficient market hypothesis assumes that market participants are rational actors, and humans faced with economic decisions are not rational actors. Fear and greed makes people do things that are irrational all the time in the context of economic decisions. And behavioral economics is a study of that. I found it really fascinating. We touched on it a decent amount here, and just exposure to a bunch of world-class, alumni and inspirational folks that came and talked to us over the years. And it was a great experience. I look back on it with really, really fond memories.
That's awesome, man. Let's move to some rapid fire questions. So as quickly as possible, what do you consider your most valuable failure?
There was a job that I really wanted at a hedge fund in San Francisco. I was at Simmons & Company. I was interviewing for hedge fund jobs. I got the opportunity to get a really good one. I got 6 rounds through the interview. It got down to me and one other guy. The other guy, out of the hundreds of people that they were interviewing, the other guy was literally my cube mate at Simmons. And he got the job offer, and I was devastated because I didn't think there would be any way that I was going to get a job opportunity that was going to look as good as that one. And then 2 weeks later, a headhunter called with the Magnetar opportunity, and it turned out to be such a better experience than what I would have had if I'd gotten that job. And with just a little bit of hindsight, not even a lot of hindsight, like a year later, it was like, oh man, this is a way better gig than that gig.
Yeah.
And from that time on, it fundamentally changed how I viewed not getting something that at the time I really wanted. You try your best. If you want something, you better go for it, and you better give it 100%. And that way, if you don't get it, you don't have any regrets. But I think even more importantly, it taught me that the way the world works out is sometimes the things that you really want that bad, that ain't for you. And I truly believe that. And so, yeah.
Sure. And it's your intrinsic value as a business person in that moment is the same whether you got the yes or got the no. And so I agree with with one of the underlying precepts of what you're saying there, which is all you can do is make yourself the best person you can be, is make yourself the best business person you can be, the best member of your community, et cetera. And then it can be a little disconcerting because the signaling that you're getting is not always the signaling that you want. But otherwise, anyway. So what do you think is people's biggest misconception of you?
Wow. You just completely stumped me. That was, let's see here. I'm not sure how much I concern myself with what people think about me.
Well, that's
so
good.
I think I'm having a hard time. I'm not sure I'm not entirely sure what people's perception of me is. So I'm not sure I know exactly what a misperception might be. I mean, I do have a public persona. I think if there was a misconception, I guess it would be my public persona is entirely professional. It's entirely talking about crypto and being a crypto investor and one with a lot of institutional investment experience. Mm-hmm. So I guess if I was going to say a misconception, it would be that there's nothing else to me other than that.
You were really into music for a while.
Yeah,
You've done a couple of other
super
things.
Into music. Yeah, been into music my whole life. Super active. I think it would probably be that. There's more to me than just magic internet money.
If you could choose anyone, living or dead, who would you choose as a mentor? And the only rule is you may choose a religious figure, but if you yourself are religious, it may not be a figure from your own religion.
Mm-hmm. I'll take Thomas Jefferson.
Interesting. Why him? I know it's rapid fire, but I want to hear this.
I don't know. The way that guy talked about liberty is just like some of the most inspirational stuff I've ever seen. I was going to say George Washington, but I always feel like Jefferson was a little bit more cerebral, maybe. I don't know if that's true, but like he was a little bit more of the like putting together the ideas, and George Washington was like the guy that was going to rally the troops up sort of thing. Yeah, I don't know. It's the first thing that came to my head.
He definitely dropped some truth bombs on Alexander Hamilton, at least in the stage in the stage version. Thomas Jefferson was definitely my favorite character in Hamilton. So, what is your fondest memory of TAMU?
Great question too. My knee-jerk reaction was football games.
Oh, okay.
Yeah, my knee-jerk reaction was football games. Although, another thing that just immediately popped into my head was getting the phone call. I was standing like 50 yards away from this room when I got the phone call that I got the job offer from Simmons & Company, which was, I felt like a culmination of a bunch of hard work here.
Sure.
Those are the first two things that popped in my head. So.
I like those answers. And almost everyone we have in says two answers to that. One of them is usually like a professional answer or an academic answer. And then the other one is something sports related. And I think it's really important for the administrators of top level universities to understand how important that is for our memories of a place.
Yep.
So we close each session with some good bull. This is an opportunity to recognize someone else for something good or great they have done. Do you have anyone you would like to send some good bull?
Definitely my team at Ikigai back in Los Angeles. Those guys have been, and girls have been tremendous. And have helped us build this platform very quickly, and I'm deeply appreciative of all those guys. And I'll just say, does Miss Guyton still work here? She does. I'll just say shout out to Miss Guyton for my Finance 341 intro class that started me down the very broad rabbit hole that has now been 10 plus years of a career in finance at more or less the highest level. So appreciative of that.
Where can our listeners find you?
Yeah, so Twitter's good. Travis_Kling, Kling. I'm active there. If you want to learn more about my my investment management firm, ikigai.fund, IKIGAI.fund, would love to have more conversations about this. So if you're listening to this and you're like a big crypto guy, please reach out. Love to have back and forth with different guys. And this is all I do all day, every day. So enjoy having those types of conversations. So appreciate it.
All right. Well, thanks for taking the time to come on the show. And thank you to the listeners for tuning in.
Cheers. Thanks, Ben.
Thank you so much for watching. If you would like to stay up to date on our latest videos, be sure to subscribe and hit the bell icon to receive notifications. If you're in a rush or on the road, you can still join us on iTunes, Spotify, or wherever you find your podcasts. If you want to learn more about us or our guests, please visit our website at mays.tamu.edu/podcasts. Also, please check out Mays Business School's academic programs. They're the sponsors of our show, and you can find them in the description. Thanks, and gig 'em.